former chairman of the Federal Reserve, Paul Volcker, set to testify before the Senate Banking Committee just about 2 hours from now. We have learned that Mr. Volcker plans to tell senators that hedge funds and private equity funds should be allowed to both profit and fail without government intervention. To discuss this news and all the implications of the so-called Volcker Rule, we have a stellar roundtable for you. Robert Heller is a former governor of the U.S. Federal Reserve Board and is the former president of Visa USA. He joins us from San Rafael, California. And with us here in the studio, Ernest Patrikis. He spent 30 years at the New York Fed and worked closely with Paul Volcker. Following 8 years at AIG, he joined the law firm of White & Case, where he is now a partner. Gentlemen, thank you so much for joining us here today. We appreciate it. And Mr. Heller, if you wouldn't mind, let's start with you. In his testimony today on Capitol Hill, what are you expecting Mr. Volcker to tell lawmakers?
Well, I would expect him to argue that there should be limits, sharp limits on proprietary trading for commercial banks, as well as restrictions on the hedge funds that they may be able to sponsor, or other funds that would put the bank's capital at risk.
Mr. Patrikis, about that argument that he is going to be making today, Mr. Volcker, tell us your thoughts on that.
Well, my view is that, first, Paul truly believes what he's saying. He is not like proprietary trading for a long time. But I really don't think he's right on this one. And part of the issue is banks, and then there are bank holding companies that own banks and their non-bank subsidiaries. And it's a little confusing as to when he's talking about banks or their affiliates. And that's one of the things that we need to talk more about, its impact on companies like JP Morgan and Goldman Sachs and Morgan Stanley and Bank of America. It really depends on the nature of your business.
Gentlemen, let me just make a quick interruption. We have some news on AIG. And Mr. Patrikis, I understand you worked there for quite some time. So let me bring you the news and perhaps a reaction from you, basically saying AIG bonus cuts will move the insurer, AIG, closer to meeting the Feinberg demands, that referring to, of course, the Paymaster Kenneth Feinberg. AIG derivative staff agrees to these bonus concessions, according to people close to the matter. The staff is said to forego, here's the key figure, $20 million in bonuses. So AIG derivative staff, and the derivatives is where so much of the controversy occurred with how AIG paid its counterparties in the wake, or the height of the crisis, I should say. The derivative staff is said to forego $20 million in bonuses. So I'm kind of deflecting the topic here, Mr. Patrikis, but we're so fortunate that you have experience with this company. How does this news come to you?
Well, I'm not enamored of Mr. Feinberg and what he's doing to AIG, period. He seems to try to push people out. If you're really good and you find your bonus is disappearing, you're going to go someplace else. For the people at Financial Products, it's another story. The issue there is it's important that these people manage their book and bring their book down where it's not systemically important. And they need to get enough of a bonus to stay there. And so if the amount is reduced too much, they leave. If the people at FP have agreed to it and they've made a deal they're happy with, I think that's fine.
Mr. Patrikis, might I ask you, because you say you're not enamored of what Mr. Feinberg's doing, specifically what gives you pause?
I think there was the issue with 5 people earlier this year. There's an issue with the bonuses that people were promised. AIG was a generator. It was like Citigroup and Citibank years past. Many people from the industry came out of AIG. Would you go to AIG today if you couldn't get a good day's pay? I think problems in attracting people, problems in keeping people. What has been done is a great company's been destroyed.
One quick final question on this news: $20 million in bonuses that the derivative staff will forego. Is that the right balance? Is it enough to keep the AIG, current employees satisfied, prevent that talent drain?
That I can't tell. I mean, that's going to be an issue: who stays, who goes.
All right, gentlemen, thank you so much. Mr. Patrikis, thank you. It kind of took a left turn there, but we appreciate it anyway. We were talking about the Volcker Rule. The former Federal Reserve Board Chairman Paul Volcker set to testify on Capitol Hill today. Let's bring back in the former Fed Governor Robert Heller. He joins us from California. And sir, you say that the proprietary trading rule would be a good idea. You say that prop trading is close to gambling. Could you elaborate on that, please?
Well, in proprietary trading, the bank essentially allows its traders to take positions for let's say, the euro to go up, for interest rates in Australia to decline, or other speculative positions. And if they pan out, the bank makes money. If they lose, which happens just as frequently almost, then the bank loses money. And that is putting the FDIC-insured deposits and ultimately the taxpayers' money at risk. And I think they should be gambling, not with any exposure to the taxpayer, and therefore the Volcker Rule is a good rule.
I see it as two parts. One is, what do commercial banks do as opposed to their brothers and sisters? And banks trade U.S. government securities, federal agency securities, Canadian government securities, municipal securities, foreign exchange. I don't think we want to see commercial banks stop engaging in those proprietary trading activities. What would do to the market. Go to the cross-stream affiliates, non-bank subsidiaries of bank holding companies. There are 19 primary dealers who deal in Fed securities, who deal in Treasury securities, whose counterparty is the Fed. These people are expected to make markets in securities. They do proprietary trading. Are they going to have to break off part of the business? And one, the credit crisis was not caused by proprietary trading at all. If this is prophylactic, if we're talking about the future, there's a difference between black and white and use of prudential supervisory tools.
Even though it does, some may argue, right, lead to systemic risks. So what is your advice on the best way to manage this risk?
That would be something like capital charges, much better supervision by bank supervisors, something, there's on and off Glass-Steagall. If we make a mistake, it's forever, because it's too hard to get legislation changed. Whereas a supervisory tool, increased capital standards for banks or bank holding companies, that's something that's a bit more reasonable.
And Mr. Heller, we have about 30 seconds left. I apologize because we did have that AIG rule, but I was wondering if we can let you have the last word on this.
Well, Mr. Patrikis threw a lot of things on the table at this time. I'm for increased capital requirements for positions, open positions, sharply increased, whether it's a prohibition or whether it's a sharp increase in the capital requirements, probably doesn't make that much of a difference. Banks got to be in the business for trading for their customers, but that is very different from taking their own speculative positions.
Robert Heller, the former Fed governor, Ernie Patrikis of White & Case. They're going to follow this hearing for us today, and we'll probably get some more comments on this as this goes forward. Gentlemen, thank you both so much for joining us here in the 12 o'clock hour here at Bloomberg.
Thank you. Good seeing you, Bob.
Friendly debate.
Thanks.
Well, the